Welcome to our tutorial. Stocks versus ETFs versus index funds. What's the difference? Please like and subscribe our channel.
If you had invested $10,000 in Apple in January 2010, that single purchase would be worth over $500,000 today. But if you had placed that exact same $10,000 into Enron stock a decade earlier, your investment went to absolute zero. When you tie your financial future to the performance, the scandals, or the failures of one specific corporation, you take on concentrated risk. You might pick the next tech giant, or you might pick a company that collapses after a single bad earnings report or a rejected FDA drug trial. Picking individual stocks is a remarkably high-stakes gamble with your decades of hard-earned savings. Even professionals struggle to win that gamble. Over 15 years, the vast majority of actively managed funds fall below the baseline index. Because finding winners is statistically difficult, Warren Buffett has a simple rule: don't look for the needle, buy the haystack, the S&P 500. So you decide to follow that advice. You log into a brokerage account, search for the S&P 500, and immediately hit a wall. You have to choose between buying an exchange-traded fund or an index mutual fund. To a beginner, they look like the exact same thing. But clicking the wrong button based on how you personally plan to invest can quietly trigger massive tax penalties and hidden fees over your lifetime. The S&P 500 itself is just a mathematical list. It is a theoretical measurement of the largest U.S. companies, which means you cannot buy it directly. To turn that list into something you can actually own, a financial institution has to step in. They gather money from thousands of investors, pool it together, and use that cash to physically purchase proportional shares in all 500 companies. Under U.S. financial regulations, these structures are officially categorized as open-end investment companies, or open-end funds. Once that massive pool of stock is assembled, the institution has to give you a way to buy a piece of it. This is where the path splits into two completely different mechanical vehicles. The first vehicle is the traditional mutual fund. If you place an order at 10 a.m., absolutely nothing happens. Your order sits on a batch with everyone else's, waiting until the market closes. This diagram illustrates exactly what happens at the closing bell. The fund calculates its net asset value, or NAV. It takes the total market value of all the pooled stocks, subtracts any liabilities, and divides that by the number of outstanding shares. Every single person who placed an order that day receives their piece at that exact single price. Because the fund processes everything as one massive math equation at the end of the day, you can buy in with flat dollar amounts. If you invest exactly $200, the fund simply issues you a varying decimal fraction of a share based on that day's NAV. That precise dollar matching makes the index mutual fund the ultimate set-and-forget tool. You can set up your payroll to send a fixed amount every 2 weeks, buying exactly that much of the market while entirely ignoring daily price swings. The second vehicle, the exchange-traded fund, takes that exact same basket of 500 stocks and lists it on a public exchange. It trades continuously, exactly like a single stock. This diagram shows how that changes the pricing. Instead of one calculation at the end of the day, an ETF has a bid column for buyers and an ask column for sellers. The price fluctuates second by second based on immediate demand, with trades executing in the narrow gap, or spread, between them. Because an ETF trades continuously, you get access to advanced order types. You can set a limit order, telling your broker to only execute a buy if the fluctuating price drops to your exact target line. Or you can use a stop order to automatically trigger a sale to protect yourself against sudden crashes. Behind the scenes, ETFs use a highly specific mechanism called in-kind creation and redemption. Instead of the fund managers selling stocks for cash when investors want out, specialized institutions called authorized participants literally swap raw stock shares for ETF shares. Because no cash actually changes hands inside the fund during these swaps, the ETF avoids realizing capital gains. That makes it incredibly tax efficient. With an ETF, you trade the automated simplicity of the mutual fund for granular tactical control and vital tax efficiency in taxable accounts. If you buy an S&P 500 ETF or an S&P 500 index mutual fund, you are holding the exact same 500 companies. Before fees, the performance is nearly identical, but the fees dictate your actual returns. This chart projects a $100,000 investment over 30 years. The top line shows the growth with a tiny 0.03% passive index fee. The bottom line tracks the exact same returns, but with a 1% active management fee. Over 3 decades, that percentage difference anchors your portfolio down, costing you over $33,000 in lost wealth. So how do you choose? You should play the mutual fund card if your goal is strict, hands-off automation. If you want to invest a specific, exact dollar amount every month and completely ignore the stock market, this vehicle does the work for you. Play the ETF card if you demand intraday control over your execution price, want the safety net of protective limit orders, or if you are investing in a standard taxable brokerage account, where shielding yourself from annual capital gains is critical. The greatest risk to your money isn't choosing the wrong index vehicle, but rather paralyzing yourself with the choice. The winning strategy is picking the vehicle that fits the mechanics of your life, holding it through the inevitable market panics, and letting compounding time do the heavy lifting.
That's a wrap for today. See you tomorrow with another lesson.
Don't forget to like and subscribe. See you then.
The information provided on this podcast is for educational and informational purposes only and should not be considered financial, investment, or legal advice. I am not a financial advisor, and the strategies or assets discussed may not be suitable for your personal financial situation. Investing involves risk, including the loss of principal. You should always consult with a licensed professional before making any financial decisions.